There are 5 particular situations in which buying single stocks is better than buying ETFs, and today we're gonna dive into them. I hope you guys are well. I'm Rick, and if you know me already, you know that I'm an ETF enthusiast because I think that ETFs and index funds are the best way to optimally diversify your portfolio and to avoid picking a stock that at some point falls off the sky like this. But this year I added quite a bit of single stocks to my portfolio, and I thought of making this video because there are indeed some situations in which buying single stocks is a good idea for the average investor. You might agree or disagree with me. In both cases, I'd love to hear from you, so write me a comment anytime with your ideas. Before we start, if you're interested in finance or investing, don't forget to subscribe to my channel because you'll get a nice mix of business tips, finance and investing all from a single channel. Now, the reason number 1 is the good old market crash. Basically, what we've seen since 2022. Market crashes happen again and again and will keep coming. Peter Lynch, one of the most famous American investors and mutual fund managers, says that there is only one thing you can know about the stock market, and that is that it goes up and down, up and down. In a little over 100 years, the market has crashed by more than 10%, almost 60 times. Around 20% of these times, the market crashed by more than 25%. The last one being the COVID pandemic, and again, last year, almost 25%. So imagine, on average, every 5 or 6 years, the market crashes by more than 25%. And by market, I mean the total stock market. I don't mean individual companies. But just as some individual stocks grow stronger than the markets in bull market periods, the same stocks usually drop much stronger in times of crisis. Take, for example, some big companies like Google, Facebook, or Amazon during the COVID pandemic crisis in March 2020. Crises often have little to do with the real financial results of single companies. It's more of a domino effect given by the panic of people that start selling and keep selling for the fear of losing more. So if good companies grow more than the market but drop more in times of financial crashes, during a market crash, it might be a good idea to buy some individual stocks of proven successful and financially stable companies. Of course, you still have to analyze the companies and make sure they're gonna keep growing, but you do have the advantage of seeing the stock prices all the years before the market crash. And also, you need to be careful about small companies because they could actually go bankrupt or struggle to recover from the crisis. Number 2 are temporary fixable issues. Facebook had one of those incidents in 2018 when news broke that they allowed third-party developers like British political counseling firm Cambridge Analytica to access the data of more than 50 million users without their permission. And this scandal cost the reputation of Facebook, and the company's stock price dropped 40% from its peak around July 2018. Another example was when Volkswagen lied about the emission values of its diesel engines. In 2015, Volkswagen admitted to installing a software that significantly changed emission performance results in diesel engines sold in the United States. The company's stock price tumbled by about 30% within days of the emission scandal breaking. Corporations are run by people. As such, they are prone to make mistakes. Whenever a company makes one of those mistakes, usually it results in a huge drop in reputation. Whether it's a cell phone that overcharges and starts exploding, a failed marketing campaign, or the downfall of a CEO of a company, several factors can cause a company's stock to drop. If you identify one of these situations in a company that otherwise shows sound financial numbers and the ability to survive such scandals, buying into this company might be a great opportunity compared to an ETF to achieve great returns, since usually the world gets over such scandals after some time. Number 3 is industries with wide dispersion. Buying an ETF of a particular sector or industry means getting the average return of that industry, which can be a good thing or a bad thing. If you take all the companies included in an ETF of an industry, you're gonna get a certain dispersion of the returns that each company achieves. For example, you could have an ETF where all companies did between 20% and 70% return, or an ETF with companies that did between -70 and plus 300%, just to give you an idea. Now, if the dispersion is really high, namely you have some really good successful companies within the ETF and some terrible ones, if you're able to identify the good companies and you buy them, you have a high chance of getting higher returns than the ETF itself. But let me give you an example to make it clear. The retail industry is a good industry for stock picking. This is because ETFs in this sector cover a huge amount of companies that tend to have a wide dispersion based on the products they sell. For example, famous retailers that sell electronics tend to have higher growth than companies that sell home textiles. If you buy a retail ETF, you're forced in a sense to buy both the electronics shares and the home textile shares, giving you the average of the industry. But if you know that some companies sell product categories that have better returns, you might want to invest in just those companies instead of the whole industry. But it doesn't have to be necessarily a difference in product category. We can say, for example, that online retailers usually perform better than physical stores because they don't have the same operating costs. although it's not always like this. So for example, you might want to invest in online retailers and avoid physical retailers. Of course, I must also say that there are so many ETFs that you can actually buy an ETF just for online retailers. Situation number 4 is when you have some personal insights about a company that the majority of people doesn't. Now let's make something clear. You're never gonna be able to have better insights than the market on a big company. There are financial institutions all over the world that every day analyze these big companies, and above all, Wall Street and all the other institutions always get tips and insights before you do. But as Peter Lynch says in his book One Up on Wall Street, small and medium cap companies are usually not so often analyzed by Wall Street or by big financial institutions. So if you can't beat Wall Street in their own playfield, you may try to beat them in your playfield, focusing on smaller companies. Smaller companies carry bigger risks. The company could face problems and go bankrupt at some point, or it could also never grow and you find yourself stuck with a loser for years. So generally speaking, I think that all investors are much better off with ETFs, but if you have some personal insights about a company that all the other people don't, it might be a good idea. For example, you may notice that some of your friends start buying clothes from an online retailer that is not so famous, but your friends tell you how great their products are. This might be an insight of a company that could have a boom in the next few years. So maybe you do some financial analysis and you find out that the company has upgraded its stores and hired new product management staff, and the new products they rolled out are going extremely well. But so far, the market hasn't noticed. Now, this kind of insights might give you an edge in buying an individual stock compared to buying the whole retail ETF. Number 5 is patience. Wall Street has a tremendous advantage when it comes to big companies and information about the stock market. But the advantage you have is that you manage your own money. Let me explain this. Wall Street can invest better and quicker than you, but they invest with other people's money. Because of this, they are dependent on the choice of their investors. So when a Wall Street investment fund starts underperforming the market, many investors start pulling their money out because they don't want to lose more. And Wall Street cannot do anything about it. So when people pull their money out, the prices are dropping and more people are going to be afraid and take their money out of Wall Street. As a result, Wall Street is usually unable to do long-term investments. The situation is even worse because every time the market goes well, and therefore the stocks are overpriced and shouldn't be bought, everybody wants to ride the wave and therefore gives money to Wall Street. And whenever there's a market crash and prices drop, which is the best moment to buy, Wall Street has no money to invest because all the investors pull their money out. This is what they mean when they say Wall Street sells on bad news. But since you're investing with your own money, you have the possibility to be much more patient than Wall Street will ever be. This allows you to invest in single companies that in the long term can give you a much higher return than an ETF. If you choose the company well and you don't freak out when because of some news the company's stock value drops. I personally like to have a healthy balance between stocks and ETFs, and my portfolio is much more focused on ETFs. But it's true that you learn much more by analyzing stocks, and buying individual stocks does give you more control over your portfolio compared to index funds. Nevertheless, stock picking is a very dangerous and hard thing to do, so you're almost always better off by investing in index funds. I'd love to hear what you think about this, and if you think there are some other situations in which buying single stocks is better than buying ETFs, just write it down in the comment section below. And if you haven't, guys, check out my last video about the perfect ETF portfolio for 2023, which is focused on the best ETFs you should buy this year. Don't forget to subscribe to the channel, guys, and hit the ring bell so that you'll be notified of new videos. I wish you a great evening, guys, and as always, I'll see you in the next video. Ciao!